Brad Williams, Frugal Finance. Let's have a little fun here. Growing annuity. Here's a more realistic example. A gold miner has absolute mining rights for 20 years. It can mine 5,000 ounces per year. Price of gold is $300 an ounce. The annual growth rate is 3%. The discount rate is 10%. What's this mine worth today? Today, we can use a growing annuity. Here's the formula, similar to the previous example. For 20 years. Well, we can simply go 1,500, 1.5 million, which is 5,000 ounces times $300 an ounce is 1,500. 20 years is 17,760,000. That's 20 years down the road. What's that worth today at 3% growth? We're not looking at a growth factor here, are we? So we have gold prices at 300. We have the growth rate of 3%. We have 20 years. We have a discount rate. Why? Because I have an expectation. I have earnings, and I need a return. And it's got to be 10% or more. Gold production annually. Here's what this is worth. This 17,760 does not take into account this 3%. So what you'd want to do is just take this 1.5 million times 1.03 carat. How many years is this? 20? That's 3% discount rate, annual growth rate. It doesn't say anything about, and that should come up with a number, and then we discount it back. In summary, if we use this formula right here, here it is in action, 1.5 million times 1.03, that's the growth rate. Remember I said without playing around, you could just do this hardcore number. We're discounting here. If you want a hardcore number, you just go this 1.03 carat 20. That should give you a value. This is discounted to 16,145,980. If we look at this thing and we discount it back, we're going to get 1765.78. C18 times 1 plus C11. C11. All right, here's your growth rate. What we're taking is this, and then we're taking E18, this number, times 1 plus C11. C11. I'm just taking this growth rate, 1 plus C11. So we took this 1,404, we discounted it. We're just playing around here, and this is how we come up with the 16,145,980. What we did is we went 1.5, we grew this to 1.545. That would be the growth rate, C11 right here. Then we discounted this number, D18, at 10%. This is the long way of doing it. This is the short way of doing it. Now, if I lost you, and I said you could do this compounding and what have you. If I lost you, all you're taking is 1.5, taking it, and this should be 3% higher. Then we discount this to 145. Then we take this 1,404, we multiply this times 3%. E18 times 1 plus C11. Then we're going to take this is equal to C19. I guess we could have done this shortcut here. Then we're going to discount that, and then so on and so forth, because these numbers are the same. So I probably could delete one or the other. I do that from time to time. I just do a lot of verifications, and sometimes I forget to delete stuff. In the end, all we need are these two numbers. 17,760 discounted over 20 years at 10% equals 1,614,980. So could the miner sell this today for 16 million? Doubtful, but you got to have a target number. You got to have a starting number. Someone does. And if it's the bank trying to sell the property, they're going to try to sell this at 16.1 million. And if you're the bank on the other side buying it, you're probably going to use a completely different discount rate. So for example, if this number, I don't know, I want to do that. Let's see. If we change this to 8%, so now we have 18,926,931. Well, let's say you're the miner. You're going to use a discount rate of 8%. The bank is going to use 10%. Now it just becomes down a piss and match as to how did you derive at this number? And then the negotiations start. And in the end, it'll be 9%. Anyway, having some fun looking at some real life situations and how you can determine valuations. Brad Williams, Frugal Finance. Thanks for watching.